Okay, let's dive right into this explainer. We're looking at a wild paradox today. How exactly do credit card companies rake in literally billions of dollars while seemingly handing out free rewards? I mean, if you've got a piece of plastic in your wallet right now, you're a crucial part of this whole ecosystem. We're going to break down the architecture of credit card profitability today. But here's the real goal. We're deconstructing their profit engine so you can learn exactly how to defend your wallet and sidestep their biggest cost traps. Let's get into it.
Because honestly, it's the ultimate consumer illusion. Think about it for a second. If they're footing the bill for our first-class flights, our luxury hotel stays, and those massive sign-up bonuses, how are they getting so incredibly rich? The secret isn't magic. It's just highly calculated math. They understand human behavior better than we do, and they leverage exactly how we use our cards every single day. And the contrast between what we see and what they see is just wild. On our side, it's intense gamification. We see rewards, cashback, travel points. It gives us that little dopamine hit, right? It feels like free money. But flip the script. On their side, it's an incredibly efficient, highly calibrated profit extraction machine. We see a free flight, they see billions in net profit. So how do they actually turn our points into their massive payday?
Well, let's look at the mechanics. We're going to pull back the curtain on the gears turning behind every single swipe.
And to really get this, we need to look at what I call the 3 pillars of profit. Breaking these down reveals a pretty brilliant multi-pronged attack. First up, you've got interest from unpaid balances. That falls directly on the cardholder. Second, merchant fees on every single swipe, which are paid by the store. In the biz, they call these interchange fees or swipe fees. And here's a crazy little aside. Retailers usually just bake those swipe fees right into the sticker price of their goods. So even if you're paying in cold, hard cash, you're actually subsidizing the credit card rewards of the guy standing in line next to you. And finally, the third pillar, service charges like late and annual fees, also paid by the cardholder.
Let's zoom in on that first pillar for a second, interest. This is where the financial engineering gets super aggressive. When you don't pay your full balance, they hit you with interest on whatever's left over. Industry insiders actually call folks who carry debt from month to month revolvers. And thanks to compounding interest, a relatively small balance doesn't stay small, it balloons. Over time, that compounding effect can easily turn a completely manageable purchase into hundreds or even thousands of dollars of pure profit for the bank. It's just money evaporating from your pocket for the privilege of carrying debt.
Okay, but what if you're not paying interest? Well, that's where those interchange fees kick in. Every time you tap or swipe, the business pays a tiny cut, usually between 1.5 and 3%, just to process the payment. And sure, 2% sounds like peanuts, right? But think about the sheer volume here. Millions of swipes happen every single hour globally. It's an invisible cost to us as consumers. You don't see it on your monthly statement, but it quietly generates an absolute avalanche of consistent revenue for the financial networks. Then you've got those pesky service charges, late fees, annual fees, all those miscellaneous penalties. The real driver here is just plain old human psychology. I mean, it is so easy to miss a due date by one day or totally forget to cancel a card before that hefty annual fee hits. The issuers are literally banking on those minor slip-ups. And it's not just a flat fee. One missed payment can trigger a whole cascading effect, like penalty APRs that jack your interest rate up to astronomical levels in a heartbeat. It's a volume game, completely built on the inevitability of human error.
Which brings us to a really fascinating question. Who exactly is their favorite customer?
You'd probably assume they love the super responsible person who uses their card flawlessly, right? Nope. The entire industry hinges on this one crucial dynamic. They earn the absolute most from customers who regularly carry a balance, the revolvers. On the flip side, you know what they call folks who pay their bills in full every month and never pay a dime in interest? Inside the industry, they call them transactors, or get this, deadbeats. If you pay your bills in full, you're low profit. Honestly, if everyone suddenly became a deadbeat and paid off their balances completely every month, these massive rewards programs would probably collapse overnight.
I just want to pause here and let that sink in for a second. They earn the most from customers who regularly carry a balance, rather than those who pay their bills in full. The ideal, absolute most profitable customer is the one who is trapped paying high compound interest month after month. There is a really dark irony built into this whole ecosystem. The consumers who are struggling the most financially, the revolvers, are effectively the ones subsidizing the first-class flights and the luxury perks for the deadbeats.
All right, so keeping your money. Now that we've exposed the engine running behind that plastic in your wallet, let's talk about exactly how to defend it.
We can translate all of this into a super actionable playbook for you. Step 1. Audit your fees. Seriously, sit down and calculate if that hefty annual fee is actually offset by the rewards you're getting. If it's not, downgrade the card. Step 2. Always pay the full balance. Literally, the best move you can make today is to set up auto-pay for your full statement balance. It completely neutralizes their biggest weapon, compound interest. And step 3. Avoid late payments, which, hey, auto-pay fixes too. It ensures you never trigger those cascading penalty rates. Basically, you have to transform from a revolver into a deadbeat to outsmart their system.
By fundamentally changing how you interact with your credit card and rigorously following those steps, you stop feeding their profit machine. Think about it this way. Every single dollar you save by not paying an 18 or 24% interest rate, that is effectively a guaranteed, tax-free return on your money. You keep those hundreds or thousands of dollars right where they belong, working for you, not padding the bottom line of some massive financial institution.
At the end of the day, the credit card industry has built a pretty perfect casino. And just like any casino, the house is designed to win. But the beautiful exception to their rule is this. If you absolutely refuse to carry a balance, you get to play entirely with their money. So the next time you go to swipe for a purchase, ask yourself one vital question. Whose pocket is your money really going into? Are you using the system to your advantage, or are you the one quietly funding the architecture of their profitability? Thanks so much for joining me on this explainer. And hey, stay sharp out there.